This is Satya Pradhuman of Cirrus Research. The briefing report is just out. The title, Short Duration to Lead as Markets Spin on Iran's Axis. The definition of short duration is effectively to become more conservative, looking more towards income strategies, looking more towards lower multiples when it comes to the equity definition of duration. The uncertainty that's really surfaced given the Iran war, in addition to that, the duration, the ongoing length of it, combined with the spike in oil prices, they all sort of forge a very adverse backdrop for risk assets. And certainly that played out in March. When we look at some of the performance fallout, it's clearly that we've moved from virtual financial asset world to real world assets. In other words, oil has rallied, the energy sector has rallied, the industrials. These are groups that are still up sharply for the year. When we look to some of the growth areas, such as the Mag 7, for that matter, Bitcoin and private credit as a measure through Blackstone, those are all sharply down for the year. Importantly, though, what we focus on is really, what is the risk that's coming? And, in the grand scheme of things, this is a supply chain risk that's surfacing. What is most troublesome is that credit spreads are quietly starting to rise. They've only gone up about 40, 50 basis points in the last few weeks. But the key consideration is that the level of where credit spreads are remain at structural lows. So there's plenty of room for credit spreads to widen at this point. Importantly, when it comes to AI, that has really taken a back seat to the war and real world events. So the market, as much as that is sold off, semis and AI related semis have weakened as well, not as much. The area that's really struggled the most in terms of downstream exposures during this war has been the alternate energy area, which is the nuclear segment. One area that has benefited significantly, and I would argue directly related to the conflict, are really the cybersecurity AI-related names. That bin was up about 5% for the month. So I think this is significant considering the market was down about 5%. And then finally, we flagged this relationship with rotational markets, looking at U.S. large mega caps versus the rest of the planet. And the curves seem to relate to geopolitical risk. And that is, when geopolitical risk heats up, valuations begin to matter. The richer multiples tend to struggle. And as a result, what we're witnessing the last 12, 18 months has been a rotation to overseas markets, the emerging markets. And even in the last 12 months or so, with the exception of March with the war, even small caps have done very well. They're still up year to date compared to the overall market. So this is, I think, a really neat area and something to focus on, which is as the world becomes more fragmented, valuations are going to matter more. And so what we're witnessing is that if large caps begin to give up ground, then not only will small caps do better, emerging markets and international markets will also likely follow. Take a look at the full report. And as always, happy to take your questions.